Now, for the VI students, we have done project-specific cost of capital. We are left with Wakuka, which is about within 30 minutes or thereabout, we'll be done with Wakuka. But for online students, we have not done project-specific and Wakuka, so we are going to spend a period to dissect the outstanding scope under cost of capital. But because this is a combined class and you are not at the same pace, and that's why I have to choose a different topic that we are going to treat today. All right? Because as soon as we are done with cost of capital, the next topic we are going to treat will be capital budgeting, which is the same thing as capital investment decision. All right? So now let the class begins. As part of this course that I scope, I'll be taking you this diet. Capital budgeting is one of them. You can call it capital budgeting, capital investment decision, or investment appraiser. It's the same thing. All right. And I believe majority of you in this class, at one point in time in your ICAN journey, you have experienced or you have learned about capital budgeting in the past. However, I want you to assume zero knowledge. Certainly, you are going to learn new things in this class. All right. So just assume that you don't know anything about capital budgeting. Okay. And that's why I always like to express myself using the working notes. So briefly, let's talk about capital budgeting. Capital investment decision is also known as investment appraiser or capital budgeting. It involves the process by which an organization commits its funds into long-term projects. When you talk about long-term projects, they are projects that span over one accounting period. Any project that will last for more than 12 months, 1 year, they are called capital budgets. Okay, they are capital budgets. For example, the construction of roads, construction of dams, bridges. For those of you that are Lagos State residents or Calabar, Calabar, Cross River State resident or thereabout, you will see that there are some construction activities that are ongoing along Lagos Calabar Coastal Road. You've heard the Minister of Finance about the costs of the projects that are ongoing. These are the kind of projects we are talking about. Okay? So again, as a private entity, company may want to erect its own office building, just like which of them again? Which of these? Because I stay in Lagos, so I will be using Lagos State as a case study. Uh, what's the name of this firm, this company again? For those of you that work in VI, remind me this high-rise building from by what's the former chairman of Jim Ovia. I've forgotten the name of the building where you have a Deloitte,
Civic
you know.
Center.
Yes, Civic Center. Yeah. The renewed, can I call it review or remodel Civic Center? The high-rise building. That is the one you normally see in my SFM Golden Book that I use as the photo. All right. So that is a private property. All those high-rise building, you can imagine the cost of those building in today's price. All right. So company may decide to erect his own office building. All right. So these are what we call capital budgets. You can imagine, in fact, that's one of the reasons why the Fourth Mainland Bridge in Lagos, that's one of the reasons you have not seen the physical structure of the Fourth Mainland Bridge because they require finance and other planning activities that needs to be done have not been completed, and that's why they have not seen the work to begin, and it involves huge capital outlay. These are the kind of projects we are talking about. All right. So ordinarily, it is expected that when a company wants to embark on capital projects, you have to ascertain the financial viability of the projects. You can't just say because you have so much funds somewhere idle, doing nothing, yielding nothing, you then say, okay, let me commit it to a project. No, you must ascertain the financial viability of the project. That's the normal thing for management to do because this financial resources is limited and scarce, and the little you have to use it judiciously. Therefore, company will need to ascertain the financial viability before committing its scarce financial resources into executing the project using relevant investment appraisal technique. All right, because every company wants to maximize shareholders' wealth. And in maximizing the shareholders' wealth, you have to embark on projects that will create value for the company and which will invariably maximize the shareholders' equity value. All right. So this is the introduction to capital budgeting. Now, what are the steps involved in capital budgeting decision? There are about 6 of them. One is identification of potential projects. This will involve scanning the business environment to be able to identify any investable opportunities. All right. Usually, the marketing department or R&D department or business service unit of the organization are responsible for identifying the opportunity, for scanning the business environment to spot any of the opportunity that the business can commit its funds into. All right. There are a lot of activity that will go into identification of the of potential projects. It's not just 1 + 1 = 2. There are different activities that will go into doing that. However, the responsible party within the units that are within the responsible unit, we need to meet with the management to discuss the outcome of their findings, and at the same time, in that spot, in that meeting, another department will be required to go and evaluate the financial viability of the opportunity that have been identified, which is the finance department. Now, like I said, in this step 1, it is just for identification of potential projects. All right, what are the opportunities that are in place? I could remember some years back when we used to bear the name Network Professional Academy. That was in 2017, February, all right, during the Ambo Day in Lagos State. Then the school we were using in VI, that's Victoria Island Primary School, the headmaster of the school just called me to say, oh, Mr. Adejuwon, please come. And I went to see him. He told me that Lagos state governments have given embargo for the use of public schools. Therefore, we cannot continue to use the facility we were using for our lectures. And we were in the middle of a diet, you know, around February. We're just the way we had now. We're in the middle of, we've collected money from students. What are we going to do? Are we going to return their money? If we return their money, the lecturers that have done about 1.5 months or thereabouts, who will pay them, you know? So myself and Mr. Christopher Kimbobola, we have to leave. We take a break, our lunch break to scan the VI environs to be able to identify if there is any opportunity or any space that we can use. And at the end of the day, that same day, we're able to discover the school we are currently using for our lecture. Since that 2017, we've been there, you know. So this is what we are saying. If there is need for any investments, or you need to identify, you need to scan the business environment to see if there's any opportunity or any potential, okay, opportunity within the business environment. Then step two is evaluation of projects. So like I was trying to say, once the opportunity has been identified, the company cannot just commit its financial resources into executing the project because this financial resources is scarce and you want to ensure that it is put into efficient and judicious use. Therefore, once you have identified the opportunity, then it needs to be evaluated. So a meeting will be called and then the finance department will be required to work with the marketing, R&D, and other support organization within the business, support unit within the organization. So they will require to appraise the project, whether it is financially viable. Okay? So, of course, when you say the finance department is generic, but there's somebody responsible within the department. There's somebody accountable. All right. For some of you that did the performance management, that's what we call responsibility accounting. All right. So the finance director or finance manager or CFO, depending on the size of the organization, is the one responsible for that unit. All right. So they will be the finance director together with the support team will be the one to evaluate the project. And this is where you have responsibility. Almost everybody within the organization, within the departments, we want to contribute on the project. So if the project is financially viable, then it will be recommended that the company can go ahead to commit its financial resources. But if not, of course, the director or CFO will also recommend that the project should not be undertaken because it will bring about diminution in the wealth of the owners. So that is step two. In step three, because the project is financially viable, then management will give it a no exception taking. All right. No exception taking means there's no objection. All right. No objection. So that means there will be authorization, selection, and approval of the project. If you have more than one project, then you are going to select the best among the various alternatives available. Because you have gotten management approval to go ahead and execute the project. Then, at this point, once there is an approval from the above, then the execution of the project must begin. You have to start execution of the project. This is the stage where the company will need to mobilize people and equipment to sites. All right. Of course, before you get to this stage four, a whole lot of activity from step one up to step four, up to step three. A whole lot of activity will be going on at the background because you can't just say okay. Once you are waiting for management, once you get management approval, then you begin the work immediately. Because if you are just at that point in time, you could have known the contractor that will do the job for you. All right, depending on the capital budgeting guideline embedded within the system. All right, because every organization, especially a mid-sized or large organization, they have procedures, they have policy and guideline relating to capital budgeting, and they also have committees, different kinds of committee that will be created for such programs. All right. There's a standardized way, there's a standardized way of engaging in capital budgeting activities. So before you get to this step four, you would have decided the contractor are the best among the best among the best of the contractors that have bidded or that have bid for the job. So of course, once all you are waiting for is just management approval. Once you get the management approval, then you need to call the contractor, the selected contractor. to come and begin to begin the development of the project. So at this step 4, you are going to have the contractor will mobilize people and equipment to sites, all right? And then the work activity will begin. So this is then after that, it is not sufficient for the company to have committed so much financial resources into executing the project. The company must ensure that you monitor and control the activity of the people and equipment on site. All right. Monitoring and controlling is the next step. Okay. Monitoring and controlling. Who are you monitoring? You are monitoring your cost. You are also controlling your cost. You are monitoring the equipment, the assets you have on site to ensure that the right thing is done. Now, when you talk about monitoring, you must, as a responsible organization, all safety protocol must be maintained. When you are on site as a responsible organization, your primary responsibility is to ensure the safety and security of the people and equipment on site. So to do this, it is expected that the company will have its own people on site, a representative of the company, because there are two parties. When you talk about contract, when you talk about project, that means that there is going to be a contract between two parties, between the company and the contractor, expressly stated the responsibility of both parties. However, the company must have representatives on site to monitor the activities of the contractor, because every contractor will want to follow shortcuts in order to maximize their margin. An average contractor, that's their nature. An average contractor will want to maximize their margin, because once they collect money from their clients, so they will be looking for opportunity to minimize their cost so that their margin can be so huge. All right. So that's always their target. However, as a company that takes safety very seriously, you must ensure that you have your own people on site to monitor the activities of the contractor. If the contractor has quoted has quoted that, okay, we are going to use so much materials, we are going to spend so much on labors. So as a company, there must be somebody on site. There must be people, your own people on site, to ensure that the right thing is done. The right quality and quantity of material are being used. You don't want a situation whereby you are giving substandard job, or some standard product materials are used for your project, because that may have a consequential effect on the reputation of the organization. Okay, and that's why you have to monitor the activities of the contractor. Then the other side of this step 5, which is control, you need to control your costs. The financial resources is limited. You don't have sufficient. So the little you have, you must ensure that it's being used judiciously. Therefore, finance department will be responsible for providing project updates in relating to cost. You need to know how much have you budgeted for this project in the first year, in the second year, in the third year, depending on the duration of the project. So how much do we, what is the plan? All right. What is the budget, what is the budget figure or budget estimate on the project? What is actual spend to date? How much do we forecast or project to spend in the next 1 year, 2 years, or 3 years? So you need to monitor to compare the actual spend with what you budgeted to spend. If you are going above your budget, you must call the attention of the management to say, with the trend, with the way we are going, there's likelihood for us to 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 spend, I mean, to go above our budget. So you be once you are updating the management from time to on it periodically, all right. When you are updating management periodically, maybe every month. In fact, every month is the most ideal, even though project activity is a daily thing, but in terms of reporting, every month you must give management the status of the project in terms of financials, so that they are aware of what is going on. If there's any variance between what you budgeted for and what you have actually spent to date, then you need to explain to the management, why do you go above your budget? Are you spending below your budget? It may well be that, for example, if there's an extension of time, anytime there's an extension of time, certainly there will be additional cost to be incurred. For example, for some of us, in 2020, we all experienced worldwide, we experienced a COVID-19, right? Whereby companies around the world were under lockdown during the period, you know. So as a result, during that period, there will be delay in project activities because people cannot access the sites. You can't go to the site to continue to work because everybody is under is under restriction because you can that is a protocol you must follow. You can't touch. You can't you can't get close to your fellow colleagues and all of that. So as a result, there will be delay in that. So there will be an extension of time because of the restriction of movement during that period. So again, there may be change in scope. For example, something that you don't have in the project before, maybe due to new technological advancement, you know, say, okay, let's embed this new technology into this project. When you do that, of course, that means you are expanding the scope of the project. That means you are going to spend more money for the additional scope. It is also possible that, okay, there's something you have included in the project before, but due to one reason or the other, management does not want that again, so it should be taken out. So that means you are going to reduce the scope. When you reduce the scope, your cost will go down, will reduce as well. But the bottom line is that as a finance person, as a financial expert, or maybe you're a financial analyst or finance manager, finance supervisor, or project accountant, whatever your role in relation to the project, it is important that you update management in terms of cost periodically, right? And this is not something you are going to do alone because you are not the project engineers. You are not, you are not usually, you don't work on site. Your work is restricted to the office. So once in a while, you go on site, you go and visit the site to see the project update, what is happening, so that you know where they are spending money, or you can't just be sitting down in the office 24 hours and all throughout the period till the completion till they complete the project. No. Once in a while you go to the site to go and check the activities that are ongoing. All right. You relate with the people on site. You gain more insight into the project so that when you are presenting your report to the management, you'll be able to talk through the numbers. Okay, it's not by hearsay. Not only that, you work with the project team, the project engineers, the project manager, all the project, you work with them, you get information about the status of the project. Where are they? What are the activities that are currently ongoing on the project? So that when you are speaking with a number, when you are presenting your stewardship report with the management, you are talking through the number. It's not just today. This month we have completed the concrete work and we spent 100 million naira and all of that. And there's currently this contractor is doing this or in this. So the bottom line is that you must understand, you have to get the story behind the numbers. It's not just, don't just be reporting figures. You must be able to speak through the numbers. And that is only when you are going to be relevant. Because if you allow the project engineers or project team, they are the one that will be taking your shine from the management. Because every now and then they'll be speaking with the management about you too, as a responsible person in your department. If you don't shoot your shots, nobody will do it for you. So you relate with other support group and then get information and then present that information as an expert. That is only when you are going to be relevant within the organization. Otherwise, other people, the engineers, the engineering group, they will be the one that will be talking about the project. So that is as per monitoring and controlling. But the bottom line under the monitoring and controlling is that at all times you must ensure that you do not exceed your budget. If you are going to exceed your budget, you must let management be aware that this is coming. This is the stage we are at and with the trend, with the way we are going, there's likely for us to to spend to spend additional or to require additional funds for us to be able to complete the scope of the work. Then finally, step six is a post-completion investigation. At this stage, at this final stage, management wants to ensure that the objective at which the project is being undertaken has been achieved. Okay? During the course of executing the project, there will be lessons learned. All right? All these lessons learned will need to be documented in order to aid organizations' learnings because it is possible for the manager during the course of executing the project, certainly there will be mistake here and there. My project managers will make mistake and then will correct the mistake. All the mistakes will be documented and how they were able to correct it so that whoever is coming, when next the company wants to execute similar projects, they will not repeat the same mistake. All right. It is also possible that the project manager that did the first job is no more within the organization, but because it has been documented, the experience has been documented. Therefore, incoming manager can learn from what was done in the past. All right. It is also possible that part of the job done, maybe there's a defect somewhere, then the company can call the contractor to come and correct the defect. And that is why usually in a contract, that's what we call a retention fee. Retention fee is a specific percentage, very small percentage that's usually retained with a company. You won't pay the contractor that particular retention fee until certain future dates when the management has assurance that okay, the quality of job done is satisfied, everything is okay, then you can release the retention fee to the contractor. Because if you pay contractor the entire contract price ab initio, if there's any issue in the future, the contractor may not come back. Even if he's going to come back, there may be delay. But if the contractor is aware that he or she still has some outstanding to collect from you, of course, anytime you call them, there will be willingness to come swiftly to come and resolve the issue. So these are the procedures involved in capital budgeting decisions. So you can read them through, have more understanding. Okay, the next thing we are going to talk about is the characteristics of capital budgeting. All right, briefly within the next few minutes. Now, what are the features of capital budgeting? One is that it involves huge capital outlay. When you want to carry out capital budgeting activity, a lot of money is involved. For some of you that are working in VI, you will see how high-rise buildings are springing up almost everywhere. The old ones are being refurbished. All right. So huge amount of money is needed to do this. Okay. Like I mentioned the other time, the Fort Mainland Bridge that Lagos State government I think, have been planning since the day of Ambode up to this date. They've not commenced it. Sometime 2024 or thereabout. I read it in the news then that they've selected a contractor that will do the job. I believe it's because of funding. That's why they've not commenced it. All right. Because a lot, you can imagine if you want to build the like of Third Mainland Bridge today, all right, you can imagine how much the government will spend to do that, to execute the project. It's a whole lot of money, okay? Number two is that the benefit from the project will accrue over a long period of time. At the start of the project, the company will be spending money, okay, to develop the project. As soon as the project is completed, the company will then begin to reap the reward for the foreseeable future, okay? They will continue to reap the reward. The same thing in your own owner-occupier building, your own residential house, When you are developing the project, you are just spending money, cash outflow, right? By the time you complete the project and you rent it out, you continue to earn your rental income, annual rental income, till death. Even when you are no, when even when one is no more, your family will continue to benefit. All right. So that's why we said the benefits will accrue over a long period of time, over a long period. Okay. Then number three is that it involves irreversible decision. Capital budgeting activity involves irreversible decision, meaning that once you have committed to execute the project, you can't go back because there's a contrast, there's an agreement between the two parties, between the company and the contractor. So if the company wants to rescind or you want to withdraw from going ahead with the project, certainly there will be consequence. It's not going to be for free. If the company tells the contractor that, okay, you want to withdraw the project, the contractor will tell you that I've spent so much money and I've borrowed money with interest. Therefore, all the equipment on site is not for free because I rent them there and I'm paying interest on them. So you have to compensate me for so much. If the company refuses to compensate, then there will be litigation. And if there is litigation, the reputation of the company will be in line. And you have to, every organization wants to avoid anything that will erode their image. Okay? Then the fourth one is that it is considered to be very risky. Okay, capital budgeting activity is considered to be very risky, highly risky. Risky in the sense that it involves it can resort to financial losses. It can resort to fatality. All right. So some of you will recall in 2022 February in Lagos State. You know, there was a particular high-rise building that collapsed in February 2022, somewhere around Ikoyi, uncompleted high-rise building. Lagos State government gave an approval for 15th floor, right? And then the owner of the property, with the connivance with other government officials, then they increased. The building was increased to 21-story building. It was increased to 21 floor. Now, of course, on that fateful day, the building gave in and collapsed. The most painful thing was that there were about almost 50 people that died in the incidents, including the owner of the property. You know, the some youth corpers that were there, the artisans, different kinds of artisans. The owner of the building was speaking, which is, in fact, his friend came to Nigeria just to do one or two things. He was on his way to the airport, returning to abroad. Let me just say hello to my friend. Where they were speaking, where they were talking on the site, the building collapsed on them. Why did the building collapse? So many factors were responsible. But what is clear is that there was a breach of trust because Lagos State government says they were given approval for 15th floor. They increased it to 21. It is also possible that possibly the right thing was not done in terms of course, the engineers, they know how to speak all those terminologies, testing the soil and doing all of that, even using substandard materials. Nobody can tell, but the bottom line is that and all this money, in fact, most of all these high-rise building you are seeing is not being constructed with individuals' money. It's people's money. My money, your money you kept in the bank. They will go there and borrow it and they use it for their investments. Most of the big people you see, including around the world, it's people's money. You can see that even Dangote, Aliko Dangote told us the Dangote refineries It's people's money because they borrow all the 20 billion or over 20 billion dollars spent on the project. It's people's money, all right? It's easier to use people's money than your own money because if you lose people's money, the worst case will be that they will collapse or they will liquidate your company. Whatever they can realize from the disposal of your assets, they will use it to settle the liability. But if you use your own money, if you lose, that means everything is gone. Everything is gone. So, and that's why you see the big people, the big men, the elites, they go to the bank and borrow. It's easier to borrow and then use it for your investment than to use your own money. It's too risky. It will be too risky to use your own personal uh funds to for investment purposes. All right. So these are the characteristics of capital budgeting. Now, the major work, where we have the major work is the method of project evaluation. So that's where we are going to be speaking for the next two period or thereabouts. Okay, so let's talk about methods of project evaluation. Now, basically, there are two methods of project evaluation. One is discounted cash flow method, two, non-discounted cash flow method. What do you mean by discounted cash flow method? The discounted cash flow method is a method that takes into consideration the time value of money. The time value of money connotes that the value of 1 naira today is worth more than the value of 1 naira of tomorrow due to investors' preference to have their benefits now rather than delaying into the future, including uh, inflation. So what we are saying is that when you talk about time value of money, the worth of the money you have now will be greater than the worth of the money you are going to have tomorrow due to inflation. Inflation can erode the value of money, the purchasing power of money. Not only that, there are some investors that they prefer to have their benefit now. Don't give me tomorrow, let me have it now. All right? So when you do that, that means you are considering time value of money. Okay. Now, what are the techniques under the discounted cash flow method? The techniques we are going to be discussing in class will be net present value, internal rate of return, profitability index. Okay, profitability index. We will not really talk much about that. Our focus will be on modified internal rate of return, adjusted present value, then including, we are going to talk about project duration. Project duration. So these are the techniques that we are going to talk about under the discounted cash flow method. Okay, so we are not going to talk about profitability index. That one is particularly under capital rationing. And the capital rationing is no more in your syllabus. It has been taken to financial management. But the major one where you have big things to do, they are the one I ticked, okay, including the project duration. Now, when we are finished talking about the discounted cash flow techniques, we then move to the non-discounted cash flow. But first thing first, let's talk about non-discounted cash flow. The non-discounted cash flow method of project evaluation is also known as traditional method of investment appraisal. It is a method that does not take into consideration the timing of cash flow and the time value of money. Okay? The non-discounted cash flow method is a method that does not consider the timing of cash flow, and the time value of money. The techniques under the non-discounted cash flow method are in two. The first one is payback period, and the second one is accounting rate of return. So like I said, we are going to start with the discounted cash flow method. Thereafter, we then discuss the non-discounted cash flow. So let's talk about the net present value. What do you mean by net present value? The net present value represents a technique or represent the difference between the present value of cash inflow and present value of cash outflow in capital investment. I repeat, net present value represents the difference between the present value of cash inflow and present value of cash outflow in capital investments. It is one of the techniques of discounted cash flow method. NPV is a technique that is consistent with the shareholders' wealth maximization objective. A positive NPV will increase the value of the company, and which will invariably enhance the shareholders' equity value. Okay, and that's one of the reasons, because NPV is consistent, is in consonant, is in line with the with the shareholders' wealth maximization objective. That's why NPV is the most acceptable, techniques in project evaluation, in theory, not in practice, in theory, all right, is the most acceptable. Okay, so that is as per NPV. Now, at this level, examiner cannot be asking you advantages and disadvantages of NPV. Never. They can't be asking you that, but it's good to know. Have them. Okay, it will be a positive for you if you know them. So, what are the decision rules? Let's talk about decision, or before we talk about decision rule, how do you estimate NPV? Remember, I told you that NPV represents the difference between the present value of cash inflow and the present value of cash outflow. We have done this under cost of capital when we were calculating cost of redeemable preference share and then cost of redeemable debt. All right. But how do you estimate the NPV? There are two things you can do whenever you want to calculate NPV. You can either use formula or you use tabular method. So far, we have been using tabular method to calculate our NPV. You can also use formula. Whichever one you do, you are going to get the same answer, except with a rounding error. Now, we said that if you want to use formula, we said that NPV is the difference. Okay, we said NPV is the difference between the present value of cash inflow, let me write it, PV of cash inflow, and then PV of cash outflow. And that's why you see, anytime we are computing NPV, I always advise you, you start from the positive present value, that you add up the positive present value, then you net off the negative. All right. So this is how to calculate NPV. Now, if you are using formula, then you need to expand this. I would then say net present value equal to, you are going to discount the cash inflows. All right. So let's say, for example, cash flow of year one, you discount it with the discount factor of year one, plus cash flow of year two, you discount it with the discount factor of year two, plus, let's say, of course, I don't know, we continue to extend, and then let's say we have the final year here. N is the final year cash flow divided by discount factor of the final year. So this side will represent the present value of cash inflow. then minus the present value of cash outflow. So whatever you have at the end of the day, we give you the NPV. So that is using formula. If you want to use the tabular method, like I said, you're already familiar with this. You are familiar with this table. That's what we'll be using so far to calculate NPV, under cost of capital. So that's basically that. Now, what are the decision rules for NPV? Now, number A, for independent projects. For independent projects, you accept the project if NPV is positive. Accept the project if NPV is positive, but if NPV is negative, you reject the project. What if you have zero NPV? Okay, you have what, Steve? You have zero NPV. The company can either accept, in that circumstance, the company can either accept or reject the project depending on other qualitative factors to be considered. Okay, so that's what you need to do under independent projects. Then for mutually exclusive projects, you accept any project with a higher positive NPV. For mutually exclusive projects, accept any project with a higher positive NPV. All right. Somebody will ask me, what is independent project? What is mutually exclusive project? At this level, it is possible. Examiner can ask you. Let me look for a space to write it down for you. What do you mean by mutually exclusive independent project first? So you can say independent project. Independent project is a standalone project. It's a standalone project that may be accepted, that may be accepted or rejected based on his own merits, based on his own merits. For example, the project will be accepted if it produces a positive NPV and will be rejected if and will be rejected if it generates a negative NPV. All right. So that's what we mean by an independent project. It's a standalone project. All right. Then what do you mean by mutually exclusive projects? Okay. Looking for space. What do you mean by mutually exclusive projects? A mutually exclusive project is a competing project. Mutually exclusive project is a competing project. Let me look for, cost of time. Let me look for space to just write it down. Okay. Mutually exclusive projects are competing projects. Are competing projects in which the acceptance of one will preclude or prevent the acceptance of the order. They are projects that cannot be accepted together. They are projects that cannot be undertaken together, undertaken or accepted together. That is mutually exclusive project. For example, if project A and B are mutually exclusive, comma, the acceptance of project A will result to the rejection of project B and vice versa. So this is the way you are going to, if examiner is asking you to explain mutually exclusive project and independent project, this is what you are going to say. And you have to give example. It's not sufficient to just define. You have to show examples, what you mean by that. All right. So I believe this is clear. Now, let's now talk about, we have talked about the decision rule for the net present value. We have talked about how to estimate net present value. So the next technique we are going to discuss will then be the internal rate of return. Let's talk about internal rate of return. What do you mean by internal rate of return? The internal rate of return is also known as break-even rate of return, yield to maturity, or market discount rate. I repeat, internal rate of return is also known as break-even rate of return, yield to maturity, or market discount rate. It is the rate that equates the present value of the expected future cash flows, all right, to zero. Any rate that you use to compute NPV and produce zero NPV, that rate is your internal rate of return. And that's why we are saying that internal rate of return is the rate that equates NPV to zero. All right. So the internal rate of return involves trial and error method of interpolation. All right. It involves trial and error method. There are 3 steps that you are going to carry out anytime you want to compute internal rate of return. There are 3 steps. The step 1 is to assume 2 discount rates that will produce 2 opposing NPV. Step 2, you compute the internal rate of return using the IRR formula. Then step 3, you advise on the financial viability of the project. That is, you advise whether the project should be undertaken or not. These are the 3 steps. I said step 1, you assume 2 discount rates that will produce 2 opposing NPV. Step 2, you calculate internal rate of return using the internal rate of return formula. Then step 3, you advise on the financial viability of the project. That is, whether the project should be undertaken or not. So we have calculated internal rate of return severally under cost of capital using the same formula you are seeing here. Okay, that's the formula for calculating internal rate of return. A is the lower discount rate. B is the higher discount rate. Okay. Then again, you can try on your own to read about the advantages and disadvantages of internal rate of return. What are the decision rules? What are the decision rules for internal rate of return? For independent projects, accept if IRR is greater than the company's cost of capital. For independent projects, accept if IRR is greater than the company's cost of capital. That's the decision rule. Okay? That's the decision rule. Now, if the IRR is less than the company's cost of capital, it should not be undertaken. But if IRR is equal to the company cost of capital, the company can either accept or reject the project depending on other qualitative factors. Now, for mutually exclusive projects, accept any project with a higher internal rate of return, provided it is greater than the company's cost of capital. You will see that under the internal rate of return, your calculated IRR using the IRR formula is usually benchmarked against the company cost of capital. Okay? So that's the way internal rate of return is estimated. All right. So that's that as per internal rate of return. Like I said, we have done the calculation severally under the cost of capital. So when we begin to solve questions, we'll do more of that under capital budgeting. Okay, next. Now, oftentimes, the decision of NPV may be conflicting with the decision of internal rate of return. What are the causes of conflicts between the two techniques? How do you resolve the conflict? Let's talk about it. The next thing we want to discuss is areas of conflict between NPV and internal rate of return. Now, where there are mutually exclusive projects, the decision of NPV may be conflicting with the decision of internal rate of return. Why? Because NPV may accept a project and internal rate of return may suggest another project. This is an apparent conflict between the two techniques, and they are usually caused by three key reasons. Okay, so what are the reasons for conflict between NPV and internal rate of return? The first one is the significant difference in the cash outlay of the project. When there is significant difference in the cash outlay of the project, this can result to conflict between NPV and internal rate of return. I will use hypothetical figures to explain this, but first thing first, let me mention the three. The second one is difference in the patterns of cash flows. Difference in the patterns of cash flows, especially cash inflows. Then three, difference in project sizes or useful life of the projects. These are the major causes of conflict between NPV and internal rate of return. Let me look for a space to demonstrate this for you. Let me manage this space. Let's say, for example, we have project A and then project B. These are mutually exclusive. All right. Now, let's say you will have the initial outlay. We have initial outlay of project A to be 500 million. For example, initial outlay of project B is 800 million. Okay? Then let's say we're also given useful life for each project. So year 1, year 2, year 3, year 4, and then year 5. Let's say cash inflow generated by project A in the first year is 300 million. In the second year, 250. In the third year, 180. In the fourth year, no cash flow for project A. On the other hand, project B generated cash inflow of 100 million in the first year, 180 million in the second year, right? 250 million in the third year. Then we have 300 in the fourth year. Then in the final year, this project generated, let's say, 380 million. Now, you will agree with me that discount factor, for example, discount factor at 10% for year 0, for example, will be equal to 1. For year 1, discount factor at 10% for year 1 is 0.909, 0.826, 0.751, 0.683. Then year 5, 0.621. Now, in the first reason for conflict between internal rate of return and NPV, we said when there is significant difference in the amount of capital outlay. When you look at project A and B, the outlay of project A is 500 million. Outlay of project B is 800 million. Because there is a significant difference between the two, 300 million difference. In that case, the decision of NPV will be conflicting with the decision of internal rate of return. So this is what I mean by when there is significant difference in the amount of capital outlay. Then number 2 says that difference in patterns of cash inflow. When you look at project A has positive cash flows. At the earlier part of project A, we have higher cash inflow, but in the final year, we have a lower cash inflow. On the flip side, when you look at project B, at the earlier part of project B generated 100 million naira cash inflow. At the latter part, the project begins to generate higher cash inflow. And you know that discount factor at the earlier part of a project is always higher. When you look at this, in year 1, we have discount factor of 0.909. But in the final year, we have a lower discount factor of 0.621. Therefore, any project that has a higher cash inflow at the earlier part of the project may be favored over the other one with a lower cash inflow. Because by the time you multiply the cash flow of year 1 with the discount factor, for example, project A, you are going to have 200 and something million. But if you multiply the same discount factor with project B cash inflow of year 1, so you are going to have less than 100 million. All right. So any project that has a higher cash inflow at the earlier part may be favored over the other project with a lower cash inflow. This is what I mean by pattern in cash inflow, difference in patterns in cash inflow. All right. So when you have this, it will bring about conflicts between the decision of NPV and then the internal rate of return. The last point that we mentioned that usually cause conflict between NPV and internal rate of return is difference in useful life. When you see these two hypothetical projects, Project A has 3 years life, whereas Project B has 5 years life. Project B has opportunity to recover more cash inflows. All right, Project B has opportunity to recover more cash inflows. Therefore, one project will be favored over the other projects when you have this kind of uneven project life. When you have this kind of uneven project life. So these are the major causes of difference or conflicts between decision of NPV and then the internal rate of return. Now, examiner can ask you, how do you resolve the conflict between NPV and internal rate of return? How do you resolve the conflicts? Now, when there is conflict between NPV and internal rate of return or any other techniques, all right, the decision should be based on net present value. I repeat, where there is conflict between NPV or when there's a choice between NPV and internal rate of return or any other technique, the final decision should be based on net present value. Why net present value? Because NPV is a technique that is consistent with the shareholders' wealth maximization objective. It is believed that a positive NPV will increase the value of the business or of the company, and which will invariably maximize the shareholders' wealth. And that's why in ranking mutually exclusive projects, NPV criterion is more reliable relative to other techniques, including the internal rate of return. NPV is more reliable, and that's why at all time, when you are asked to evaluate a project, it has to be based on NPV, except examiner is specific, except you are told to use any other technique. At all time, when you are asked to evaluate or determine financial viability of a project, your decision should be based on NPV, net present value. Okay, so that is how to resolve the conflict between NPV and then internal rate of return or any other technique. It has to be based, your decision must be based on the net present value. Okay? Now, the next thing we are going to discuss will then be modified internal rate of return. Let's talk about modified internal rate of return. Let me see. Okay. In this case, let me use my working note to explain the modified internal rate of return so that I can bring in more clarity to estimating modified internal rate of return. I will stop sharing this and move to the working notes. Okay. Modified internal rate of return. So what do you mean by modified internal rate of return? When do you calculate modified internal rate of return? Let's talk about it. Now, let me put it down because of time. Where there are unconventional cash flows, when there are unconventional cash flows, okay, unconventional cash flows, that is positive and negative cash flows. It is not appropriate. It is not appropriate to use internal rate of return as a decision criterion, because it will be conflicting because it will be conflicting with the decision of NPV, because it will be conflicting or it will not be in consonance because it will not be consistent with the shareholders' wealth. Generally, the assumptions behind net present value is that the cash flows generated by projects can be reinvested at the company's cost of capital, at the company cost of capital, whereas IRR suggests that the cash flow generated by projects should be reinvested at internal rate of return. Okay, so this is an apparent conflict. All right. Therefore, the modified internal rate of return, the modified internal rate of return is developed to correct the anomalies associated with the internal rate of return. The modified internal rate of return allows the decision maker or suggests or allows the decision maker to suggest the reinvestment rates or cost of capital to use for investment purposes such that or the modified internal rate of return, the modified internal rate of return assumes that the cash flow generated by projects can be reinvested at the reinvestment rates, at the reinvestment rates or cost of capital. That's it. So what we are saying here is that because of the fact that the internal rate of return is not consistent with the shareholders' wealth maximization objective, hence it is not suitable to evaluate projects where there are unconventional cash flows. Unconventional cash flow generally are those cash flows whereby you have a mix of positive and negative cash flow. In the first year, you can have a positive cash flow. Second year, you have a negative. Third year, you have a negative. Fourth year, you have a positive. So when you have mix of positive and negative cash flow, those are unconventional cash flows. So when this happens, it's not appropriate to use internal rate of return as a decision criterion because the assumption of NPV is that the cash flow that the project will generate can be reinvested at the company cost of capital, but internal rate of return is insisting that any cash flow generated by the projects should be reinvested at internal rate of return. And this is not consistent with the shareholders' wealth maximization objective. Therefore, a different technique, which is modified internal rate of return, was developed in order to correct the anomalies associated with the internal rate of return. The modified internal rate of return assumes that the cash flow generated by a project can be reinvested at the reinvestment rate or cost of capital. All right. So, and then, of course, this is basically what modified internal rate of return is. What are the procedure? How do you calculate modified internal rate of return? So come here, calculating modified internal rate of return. Basically, there are two methods of calculating modified internal rate of return. All right, methods. The method one is you can use terminal value method, terminal value. Then two, you can use present value. You can use terminal value method or you use present value method. Let me show you what you need to do under each of them. Whichever one you use, you still get the same answer, but let me show you. Let's start with the terminal value. Terminal value method. Let me shorten this because of time. Let me shorten my points. Now, this is the method. This is the method that relies heavily on positive cash flows. On positive cash flows. It can be computed the following method, the following steps. The following steps can be used can be used to calculate modified internal rate of return. The following step can be used to calculate modified internal rate of return using terminal value method. Using terminal value method. What are the steps? Step 1. Step 1. Calculate terminal value. Calculate terminal value for all positive cash flows. Okay? Calculate terminal value for all positive cash flows. How do you do this? The table below can be used to calculate the terminal value. So when you want to calculate terminal value, you can create like 4 columns. All right? The first column will be for year. The second column will be for cash flow. No need to put description of items. Then the third column will be for compounding factor. Compounding factor. Then the last column will be for terminal value. Okay. Now, for your compounding factor, the formula will be 1 plus r raised to power n. You can say raised to power n minus 1. Okay? 1 plus r raised to power n minus 1. That will give you the compounding factor you are going to use for each year. Let's say, for example, let me use figure to do this. Let's say we have for year 1, year 2, and then year 3. Now, in the question, we are given positive cash flow. We are given cash inflow of 5,000 naira for year 1, for example. Or let me do it this way. I'm going to use example in this material. Did I need example in this material? Anyway, we are going to use, let me just go ahead with this. So let's say cash flow of year 1, positive cash flow is 5,000, 6,000, then 4,000 in the third year. Now, let's say, for example, the discount factor, the cost of capital given is 10%. So what we are now saying is that, remember, we said that modified internal rate of return assume that the cash flow generated by project can be reinvested at cost of capital or reinvestment rates. Your intention is that all the cash flow generated by the project, you want to reinvest it. You want to reinvest it. Therefore, you need to ask yourself, this cash flow of year 1 of 5,000, if you want to reinvest it, how many more years can you reinvest it? And that is why you can see the useful life of this project is 3 years. That means our N will be equal to 3. So in this case, and our discount rate we said is 10%. So that will be 1.10 raised to power 3 minus 1. 3 minus 1 will give us 2 more years. Let me rewrite this. 1 let me say 3 minus 1. Then here will be 1.10 raised to power 3 minus 2. 1.10 raised to power 3 minus 3. Now, there's no need for you to, it's because of explanation I'm doing 3 minus 1, 3 minus 2. All you need to do is to ask yourself is that this cash flow of year one of 5,000 naira, how many more years can you reinvest it? In the first year that the cash flow occurs, you can't reinvest it. That year is already gone. So that means you have 2 more years. This 5,000 naira can be reinvested for additional 2 years. And that's why when you say 3 minus 2, that will give you 2. The second cash flow of 6,000 naira, how many more years can you reinvest it? Year 2 is already gone. That means you have only year 3 left. And that's when you do 3 minus 2, it will give you 1. Then the cash flow of year 4, how many more years can you reinvest it? Sorry, of year 3. That cash flow of 4,000 naira of year 3, how many more years? It's 0 years. That because that's the final year. Year 3 is the final year. So when you do 3 minus 3, it will give you 0. And at the end of the day, you multiply the cash flow with the compounding factor. Then you get the terminal value for each year. You then add it up. So this will give you the total terminal value. That is how to calculate the terminal value. Then step 2, after you have computed the terminal value, step 2, you calculate calculate the present value of negative cash flows. Calculate the present value, PV, of negative cash flows. Okay, so for example, in year 0, certainly you are going to have negative cash flow in year 0. It is also possible in between the years, between year 1 and maybe the project has 4 years life or whatever. In between years, if you have negative cash flow, you also include it in your present value calculation. All right. The same way we normally calculate present value if you want to calculate NPV. Then step 3, calculate modified internal rate of return using the formula below. Calculate modified internal rate of return using the formula below. Okay, so using the terminal value, modified internal rate of return, modified internal rate of return is computed as the terminal value over present value of cash outflow, all raised to power 1 over n, all minus 1. Then you multiply everything by 100%. Your final answer must be in percentage. So this is the formula for calculating modified internal rate of return. If you don't want to use this, alternatively, you can say modified internal rate of return is equal to square root n square root terminal value over the PV of cash outflow, present value of cash outflow, all minus 1. Then you multiply with 100%. Whichever one you do, you get the same answer. All right. So this is how to get, always use this one. This one is better. Okay. I will define the variables. Let's do the second method, which is the present value method. Then I will explain the variables. Or let me just put it here. DO, where DO equal to terminal value, DN equal to PV of negative cash flow, Then N is the useful life. Then TV, terminal value. CO, PV, PV of cash outflow. You can call it cash outflow or negative cash flow. So that's it. That's it. So let's talk about the second method, which is our present value method. Okay, present value method. Present value method. This method is particularly useful. This method is particularly useful where net present value, where net present value has already been calculated, where net present value has already been calculated. Okay, it involves the following procedures. Okay, so step one, calculate the present value. Calculate the present value of positive cash flows. Positive cash flows. Step two, calculate the PV of negative cash flows. Step three. Step three, estimate modified internal rate of return using the formula below. Okay, so usually at the back of your answer booklet, sorry, at the back of your question paper, you will likely see the formula I want to show you now. You see it there, but it's written in different ways. All right. So modified internal rate of return is calculated as PV of cash inflow, that is return phase cash flow over PV of cash outflow, over PV of cash outflow, that is investment phase cash flow. You can call it cash inflow is the same thing as return phase. There are two stages of projects. There are two stages of project, two phases of projects. the stage where the company is spending money on the project. That's when you are spending money, that's when you are developing the project. So that's when you are going to be having your cash outflow. When the project is completed, the project will begin to generate revenue. So the phase whereby you are beginning to earn or to achieve cash inflow, that is the return phase cash flow. Therefore, oh, I have occupied the space I even need. Let me remove the return phase. Let me remove the return phase. But I still other things I need to put. All right. So the phase when the company is generating cash inflow is the return phase. Then when the company is spending money on the project, that's cash outflow. That's investment phase or development phase, the cash flow. So you then multiply this raised to power 1 over n multiplied by 1 plus r multiplied by 1 plus r. Then all of this minus 1. All of this minus 1 multiplied by 100% will give you the modified internal rate of return. So this is the formula for calculating modified internal rate of return. Like I said, this second method, this present value method is suitable. In fact, it's preferable where in the question you have already calculated net present value. So if you have already calculated present value, it will make life easy for you. Instead of starting from the beginning, just pick your NPV, you add it to your initial outlay. It will give you the present value of cash inflow, then the present value of cash outflow. So just divide it, then you get the final answer. That's it. It's as simple as that. Okay, so let me define the variable where n is the useful life of the projects, R is reinvestment rates, or cost of capital. Okay, so that's that. Let me see if I can have a short example to demonstrate how to calculate modified internal rate of return. Then thereafter, our final bus stop today will be project duration, explanation of project duration. And that's where we are going to stop. So quickly, let me look for questions or a question to demonstrate this. Let me stop sharing. Let me see if I have it here. So you can read more. You can read more about the benefits of a modified internal rate of return. Okay. Now, I forgot to tell you the decision rule. The decision rule of modified internal rate of return is the same thing as the decision rule of internal rate of return. That is, if the modified internal rate of return is higher than the company cost of capital, you accept. But if the modified internal rate of return is lower than the company cost of capital, you reject the project because it is not financially viable. But where your calculated modified internal rate of return is the same thing as the company cost of capital, where they are equal, then in that case, the company can either accept or reject the project depending on other qualitative factors. Okay, so let me look for short question to demonstrate this. We are going to have a bigger, there was a particular diet whereby ICAN tested it. Okay, let's use this one. Let's use this example. Uh, let me see. Let's use this example number 5. Let's use this example number 5 quickly to solve this, to demonstrate how to estimate modified internal rate of return. Is it even necessary to have any example? Since we are still going to have it in a bigger question. Let me see. There was a particular question in that involve project specific capital budgeting, NPV, modified internal rate of return. In any case, uh, okay, let's quickly solve this example number 5. So I need one of you to read for us. I've been the only one talking since. Yes, quickly, somebody should help us read. Who is helping us?
Filipino PLC is
Thank you, Bridget.
Filipino PLC is considering an investment in a project which requires an immediate payment of 15,000 naira, followed by a further investment of 5,400 naira at the end of the first year. The subsequent return phase net cash inflows are expected to arise at the end of the following year, year 1 to 5, and required the MIR of these projects. Calculate the MIR of these projects, assuming a reinvestment rate equal to the company cost of capital of 8%.
Yeah, thank you very much. So go to page 47 in your learning material. You will see the question there because I want to stop sharing this and move to the working note quickly. Now, anytime in a question it is possible, examiner can ask you, you may be given reinvestment rate and at the same time you are given cost of capital. If you are given the two of them, always use the reinvestment rates for the positive cash flows. Always use the reinvestment rate for the positive cash flows. Then you use cost of capital for the negative to calculate present value of the negative cash flows. So note that. I repeat, anytime in a question, if an examiner give you both reinvestment rates and cost of capital, so you are going to, in that case, you are going to calculate the terminal value using the reinvestment rate. Then you are going to use cost of capital to calculate present value of the negative cash flow. So that's what I just said. Now, solution. This is solution to illustration number 5. Is it 5? Let me confirm. Yes, illustration number 5, page 47. Page 47. All right. The name of the company is Filipino. Filipino. Is it a limited or PLC? Let me confirm. PLC. So examiner is now asking us, you are to calculate modified internal rate of return using cost of capital of 8%. So how do you calculate modified internal rate of return? If I like, I can use the terminal value method. If I like, I can use the present value method. Whichever one I use, I'm supposed to get the same answer. So let's demonstrate the two. So I will then come here. I will say calculating modified internal rate of return. There is no need for you to say using terminal value method or using present value method on the day of your exam. Just go ahead, solve the question and move on. However, for the purpose of this class, for demonstration purpose, I will use the tool for you so that anyone that is more convenient for you, you follow it. All right. So A, using terminal value. So if I want to use terminal value method, how do I calculate my modified internal rate of return? I told you there are about 4 steps that you are going to carry out. The first step is to calculate terminal value. Okay, you are going to calculate terminal value. So I will then say calculating terminal value. So how do you calculate terminal value? Remember, when you are calculating your terminal value, you have to bring to bear the assumption behind modified internal rate of return. The modified internal rate of return suggests that the cash flow generated by the project can be reinvested at the reinvestment rate or cost of capital. Therefore, I will create a column for year. I want to reinvest my cash flow. Here will be cash flow. Then we have compounding factor. Compounding factor. Examiner has given us cost of capital to be 8%. So at 8%, then I will have the terminal value, not present value, but terminal value. Okay. Give me the cash flow for year 1. What's the cash flow?
6,500.
6,500. Year 2.
7,750.
Year 3.
5,750.
5,750. Year 4.
750.
4,750.
4,750. Year 5.
750.
What do you have as
3,750.
year
3,750.
3,750? Okay, I think the project has 5 years life, right? Okay then. So the next thing we are going to do is to calculate to determine the compounding factor. Let me complete my table. Now, for the compounding factor, remember we have a formula which is 1 plus r raised to power n minus 1, right? So cost of capital is 8%. Therefore, I can say 1.08 raised to power n is 5 years, right? 5 minus 1 will give us 4. Then in year 2, n minus 2, in this case, that will be 1.08 raised to power n minus 5 minus 2 will give us 3. 1.08, 5 minus 3 will give us 2. Then for year 4, 1.08, 1.08 in year 4, 5 minus 4 will give us 1. Then in year 5, 1.08, 5 minus 5 will give us 0. So instead of you to be doing all of this, just note that when you are calculating your terminal value, the first year cash flow will be raised by, depending on the useful life of the project, just minus 1 from the useful life of the project. Then you take it down like that until you get to 0. And that's what we have done so far. For example, like I said, this 6,500 for year 1, how many more years can you reinvest? You want to reinvest the 6,500 because that's the assumption behind the modified internal rate of return, that the cash flow generated by the project can be reinvested at reinvestment rate or cost of capital. So the 6,500, you want to reinvest it. This 6,500 was earned in year 1. So year 1, you can't invest in year 1 again because it has to be at the end of year 1. All this cash flow occur at the end of each year. So the one that occur at the end of year 1, it's already, that year 1 is already gone. So you have 4 more years. The one that will call at the end of year 2, How many more years? 3 years. So that's how you are going to do for all of them. So at this point, you then bring out your calculator to determine the terminal value. Okay? So from your calculator, you are going to start with the compounding factor, which is 1.08 raised to power 4 equal whatever you have in your calculator multiplied by 6,500. That's 8843. Here is 8843. Then the one of year 2, compounding factor of year 2, 1.08
976.
raised to power 3 equal, no, I made a mistake.
9763.
976.
What did you say it is?
9763.
9763.
9763, okay? Then the one of year 3,
6707.
6707.
Yes.
Year 4,
5130.
5130. Then year 5 will be 3750. Anything raised to power 0 is 1. So here is 3750. So let's add it up. Terminal value. Let's add it up. 8843 plus 9763 plus 6707 plus 5130 plus 3750.
34193. That's approximately
193.
93.
Okay. So that's the total terminal value. Step 1 says we should calculate terminal value. That's what we have done. Then step 2 says you should calculate the present value of positive cash flows. So present value of negative cash flow. Of negative cash flow or of cash outflows. So you do this one the same way you normally calculate NPV. So you have year, all right, you have cash flow, you have discount factor. Remember, when you are calculating present value, you are supposed to use cost of capital in case you have reinvestment rate and then cost of capital. So here is 8%. We are given 8%. Then we have the present value. Okay. So year 0, we have initial outlay. How much is the initial outlay of the project? 15,000 naira.
Yes.
15,000 naira. Then we're also told that followed by a further investment of 5,400 at the end of the first year. So at the end of year 1, they also invested 5,400. So here is cash flow is 15,000. Then year 1, 5,400. So discount factor at 8% for year 0 is 1. 1 multiplied by 15,000 will give us 15,000. Then discount factor for year 1 at 8%, 1.08 raised to power minus 1. What do you get? Raised to power 1 minus, that's 0.926. 0.926. We then multiply that with 5,400. 0.926. What did you say it is?
5,000.
5,000. That's it, 5,000. Then you add it up. 15,000 plus 5,000 will give us 20,000. So present value of positive cash flow is don't need to put it in negative. With the title, negative cash flow has already taken care of that. So no need to say negative cash to put it in bracket again. Okay, so then step 3 says you should calculate modified internal rate of return. Step 3, I would then say modified internal rate of return. Since I'm using terminal value method, so I'll just say terminal value divided by present value of cash outflow, all raised to power 1 over n minus 1, then multiply by 100%. That's it. So I would then say modified internal rate of return equal to terminal value we calculated 34,193, right? Then present value of cash outflow is 20,000. Raised to power n is 5. The useful life of the project is 5 years, therefore 1 over 5, all minus 1. So as simple as that. So I will then bring out my calculator to say 34,193 over 20,000 equal, then raised to power 1 divided by 5 is 0.2, raised to power 0.2 equal, then minus 1 equal, multiply by 100% equal to 11.32. So modified internal rate of return is equal to 11.32%. Okay, then I can also use the other method, which is present value method. Alternatively, let's try the other method. Alternatively, or instead of saying alternative, let me just do B, since I've written A here. Please, on the day of your exam, don't go and be showing so much skills, too much skills. Just use any one and move on. No need to be doing the two. So number B, using present value method. So using the present value method, you are going to calculate present value of positive cash flow. Step 2, you calculate present value of negative cash flow. Step 3, then you calculate modified internal rate of return using the big for nothing formula. All right. So I will say PV of positive cash flow. We have 5 different positive cash flow from year 1 to year 5. Okay. So the same way you normally calculate NPV, only that year 0 will not be there. So create a column for year. We have cash flow. We have discount factor at 8%. Then we have the present value. Year 1, 2, 3, 4, and then 5. Okay. So here is 6,500, 7,750, 5,750, 4,750, then 3,750. Here is 0.90 watts, 926. 926. What's discount factor for year 2 at 8%? 1.08 raised to power 2 minus equal
0.87.
857. 0.857. Then year 3,
0.794.
794. Year 4,
0.735.
735. Year 5,
0.681.
681. Then calculate, you multiply to get the present value. So what do we have here? 0.681 multiplied by 3,750. That's 2,554. Here is 2,554. Yes, what do you have for year 1?
019.
Pardon?
6019.
6019. Okay.
642.
6
642.
6442.
No. 6642.
Okay. Yeah, 3.
6.
4566.
4566. Yeah, 4.
3491. Abi? 3491.
3491. So add it up. Add it up.
It's 3272.
32.
3272.
23
This 23.
272.
272. Okay. So that's total PV of the positive cash flow. It then calculates PV of negative cash flow. We have calculated PV of negative cash flow before. PV of negative cash flow equal to 20,000 naira.
Okay.
That's what we calculated under the, yeah, this is it. Okay. So no need to recalculate it again. Then step 3 says you should calculate modified internal rate of return. I would then say modified internal rate of return equal to, using the big for nothing formula, PV
Sir,
of,
sir,
yes,
sorry. Sorry, but that negative cash flow is just for year 0 and 1.
yes now.
Mm, okay.
What about it?
I was just thinking, we did this one 1 to 5, and we added it together for this
Mm-hmm.
positive. But that negative cash flow is just for year 0 and year 1. Hope it
So when do you
doesn't
have the
matter.
negative cash flow? You have negative cash flow in year 0. You also have negative cash flow in year 1. That's all now. You had the two of them together. Or what's your concern?
Okay,
Talk to
okay,
me. You know, in
okay.
year 0, that's where you have cash outflow. That's your negative
Yes,
cash flow.
yes.
In year
Okay,
1, you are told that a further 5,400 was invested. That's another cash outflow. Those are the two periods you have cash outflow. All
okay,
right.
sir.
So yeah, you do them separately. So I would then say the PV of cash inflow over PV of cash outflow raised to power 1 over n multiplied by 1 plus r, all of this minus 1 multiplied by 100%. Okay, therefore modified internal rate of return will then be equal to PV of cash inflow. We got 23,272. 23,272. PV of cash outflow 20,000. All raised to power 1 over 5 multiplied by 1 plus r. R is 8%. All of this minus 1. Okay. Therefore, final answer is what? You then say 23, 23,272 divided by 20,000
okay.
equal, then raised to power 0.2 equal, multiply by 1.08. Oh, sorry, mistake. I made a mistake. 23272 raised to power 20,000 equal, then raised to power 0.2. 1 divided by 5 is 0.2 equal, then multiply by 1.08 equal, then minus 1 equal, multiply by 100% equal to 11.32. Here is 11.32%. So when you compare this with the terminal value method, you see that they are equal. So whether you use terminal value method or you use present value method, whichever one you use, you are supposed to get the same answer. You get the same answer. So that's it. That's how to calculate modified internal rate of return. All right. So finally, let's spend the remaining minutes to discuss project duration. Let's talk about project duration. Projects. Yes, Moses, talk to me. Moses, you raise your hand, talk to me. Alcohol, what's your question? Talk to
Yes,
me.
yes, sir. Good evening.
Yeah, good evening.
Mine is not question, but a kind of complaint.
Okay.
All the lectures we've been receiving, I've not been having access to the video. I don't know whether it's only me. I really need the video of all these lectures, sir.
I think maybe you have not been. Have you checked when you go to our YouTube channel, you will see all those recordings there. Usually, Mr. Wasil usually share the video playlist on the group. When you click on any of the playlists, you are going to see all the video recordings to date. Everything is there. So maybe
So
you have not been paying attention.
on which
On each
group?
of the group you register for, you will see the playlist there.
Oh, I've not
So
been seeing. I've
if
even
you
reached
ask
out.
if you ask for anybody on that group, somebody will share
Let
with
me
you.
let me reshare the video, YouTube video.
Okay. All right. Thank
Thank
you,
you.
senior.
In fact,
Thank you.
it's even pinned on the group. The playlist is pinned on each group. Yeah. Yes. Moses, what's your question? Okay. Now let's talk about project duration. Now, one thing you need to understand is that project duration can be likened to payback period or discounted payback period, but they are different. Okay? What do you mean by project duration? Let me put it down for you. I think it's not in your learning material. Let me just put it down. Um, this represents the weighted average time taken. Weighted average. What is the decision rule? Moses, you're asking what is the decision rule? We have said it already now. If your modified internal rate of return is higher than the company cost of capital, it means the project is financially viable. We calculated modified internal rate of return of 11.32. Your cost of capital is 8%. That means it is financially viable. All right, Moses. So examiner is asking you to calculate modified internal rate of return. That's all. And that's what we have done. I believe that is clear, Moses. So, like I said, project duration represents the weighted average time taken to recoup or recover the amount invested, in a project. All right. The project duration, Moses, you can take down your hand. Project duration is similar to payback period and discounted payback period and discounted payback period, except that the duration or the project duration considers all cash flows. Okay, that is difference. It consider all cash flows. Yeah, that is different between this and the payback period as well as the discounted payback period. Consider all cash flows and time value of money. Let me include it. And time value of money. Okay. How do you then estimate? When you want to, what we are saying is that when you want to determine the time taken for a company, for example, as an investor, if you want to invest 1 million naira in a project and you want to know how long will you take you to recover your money, you can either use payback period to do that, discounted payback period, or project duration. All right. So what we are now saying is that as far as the project duration is concerned, we are going to consider time value of money. That is, we are going to discount the cash flows. Not only that, all the cash flow generated by the project will be considered, unlike payback period that does not consider all cash flows. Okay? Discounted payback period too does not consider all the cash flow because after payback period, you are going to ignore the remaining cash flows. But for project duration, you consider all the cash flows. So what are the methods? Okay. What are the methods of calculating project duration? Methods of calculating project duration. All right. There are two methods. Method one, we can use weighted average method. Two, you can use present value method. Whichever method you use, you are going to get the same answer. Now, the first one, which is weighted average, how do you calculate duration using the weighted average method? To use the weighted average method, what are the procedures? First thing first, you need to calculate the present value. Steps. Because of time, let me just shorten it. Step one, calculate present value of each year cash flow. Step two, Determine the weights. Determine the weights of each year. This can be done by multiplying the number of each year, with the present value. So that will give you the weights. Then step 3, you then calculate, you compute the project duration using the formula below. So if you want to calculate project duration, you then say projects. Before that, let me show you the table. Okay, I will show you that one later. Let me just write it out. Project duration is computed as total weight over total present value. All your answer, the final answer must be expressed in years. Okay, so let me show you the table to use. For the 3 steps I just gave you above, let me show you the table. So you create a column for year. Then, if you like, you can put description of item or you ignore. Just put cash flow. You have discount factor. You have the present value. Then you have the weight. So let's say this is A, B, C. Then D will be equal to B times C. E will be equal to A multiplied by D. All right, that's all you need to do.
Please,
It's
sir,
as simple as that. Are you talking to me?
please can you show the formula again?
You will see that. Let me finish what I'm doing. So you add up the total present value. You also add up the total weights. So total weights over total present value will give you the project duration. All right. So that's that. Then the second method, which is the present value method. Present value method. In this case, oh, okay. I've not even explained the steps. For the present value method, step 1, you calculate present value. Calculate present value for each year cash flow. Then step 2, determine the proportion determine the proportion or percentage of each year present value to the total present value. Then step 3, estimates project duration. Estimate project duration by multiplying number of each year, with the proportion of PV Okay, that's it. So you can use the table below. The table below, let me see if this way can accommodate. Yes, the table below can be used to estimate the project duration using the PV method. Okay, so to do this, we create a column for year, cash flow, discount factor, present value, proportion of present value. Then you have project duration, the last column. So let's say this is A, B, C, then D equal to B times C. Then, of course, here is E, then F. F will be equal to A multiplied by E. ICAN has never tested project duration in recent time, so you never can tell, but it's part of your syllabus. You have to know it. The beauty about this project duration is that it's the same thing as bond valuation. For those of you that have done bond valuation at skills level, where Mr. Ashwaju taught you, it's the same thing. This is the same format you are going to use to calculate, modify bond duration, bond duration. Macaulay duration, then modified duration. So this is the duration total. So whatever you have as the total is the duration. That's all. It's as simple as that. So if the duration of the projects, if the management predetermined duration, if your calculated duration is shorter or equal to the management predetermined duration, it means that the project is financially viable. If not, then the project will not be undertaken because it will take a longer time than the management expected. All right. So this is how to estimate duration. I don't know if you can spare me additional 5 to 10 minutes. I can use example to explain this. If not, we are going to stop here. In our next class, we'll continue. Do I have 10 minutes of your time just to demonstrate this? What are you saying? Okay, let's call it a day. All right. So let's call it a day. We are going to meet. Moses said you are tired. Okay. It is well. All right, guys. Thank you for your time and for joining. We are going to continue next time. However, before we continue from here, from where we stopped today, we still have outstanding scope under cost of capital, which will be the first thing we are going to do in our next meeting before we then continue with capital budgeting. Thank you, everyone. I appreciate your support. I will see you next time by the grace of God.
Are you going to share your notes?
Thank you, sir.
Certainly. Certainly, I will share.
Thank you so much.